Hello everyone, welcome to the market opening bell on Friday, March 13, your 10-minute guide to the stock market. Although the US government will release 172 million barrels of oil from its emergency petroleum reserves, the entire process is expected to take around 120 days. In addition, 2 oil tankers were attacked in Iraqi waters, and Iraq's oil ports have completely suspended operations. While tensions in the US-Iran conflict remain high, Brent crude oil futures once surged above $100 per barrel, sending Hong Kong stocks lower in choppy trading. The Hang Seng Index opened 179 points down, briefly rebounded 33 points to a high of 25,932 before falling. Again, it once dropped 377 points to a low of 25,521. Later, as the rise in international oil prices moderated slightly, Hong Kong stocks recovered some ground. The Hang Seng Index closed the day down 182 points or 0.7% at 25,716. The X-share index fell 4 points or 0.06% to close at 8,699, while the Hang Seng Tech Index declined 27 points or 0.5% to 5,027. Total market turnover reached 242.1 billion Hong Kong dollars. Southbound stock connect funds recorded a net inflow of 11.283 billion dollars, compared with a net inflow of 3.448 billion dollars on the previous trading day. There was net buying of 4.701 billion in the tracker fund, 1.238 billion in CNOOC, 360 million in SMIC, 125 million in Xpeng, and 120 million in Yangtze optical fiber and cable, while net selling amounted to 479 million in Tencent and 429 million in Alibaba. The fourth session of the 14th National People's Congress closed yesterday. The 3 major A-share indexes opened lower in the morning but narrowed their losses in the afternoon. The Shanghai Composite Index fell 4 points or 0.1% to close at 4,129. The Shenzhen Component Index dropped 90 points or 0.6% to 14,374, and the Chinex Index declined 32 points or 1% to 3,317. Combined turnover in Shanghai and Shenzhen reached 2.44 trillion yuan. The renminbi central parity rate against the US dollar stood at 6.8959, down 42 pips from the previous day. Foreign media reported that the Trump administration has launched Section 301 trade investigations into industrial overcapacity of 16 major trading partners in order to rebuild tariff pressure. U.S. Trade Representative Greer said the probes could result in new tariffs on China, the EU, India, Japan, South Korea, and Mexico as early as this summer. Greer also announced that another Section 301 investigation will commence on March 12 to ban U.S. imports of goods made with forced labor, covering more than 60 countries. He expressed hope that other nations would implement similar bans and aims to complete the full Section 301 review, including proposed remedies, before the temporary tariffs imposed by Trump at the end of last month expire in July. China's Ministry of Foreign Affairs stated that it opposes politicizing the so-called overcapacity issue. Oil stocks rose with PetroChina up 1.1% and CNOOC up 3.7%, while Sinopec fell 1.4%. Aluminium stocks were favored, with China Hongqiao gaining 3.9% and Chalco rising 4.4%. Inflation worries weighed on property and utility stocks. Wharf Holdings announced its full-year results to the end of December last year, successfully turning from loss to profit. Revenue for the period was 10.997 billion Hong Kong dollars, down 9.2% year-on-year. The company swung to a profit of $50 million after losing 3.224 billion Hong Kong dollars in the same period last year, with earnings per share of 2 cents. The second interim dividend was maintained at 20 cents, giving a full-year dividend of 40 cents, unchanged from the previous year. Underlying net profit rose 46.7% to $4.104 billion, mainly because impairment provisions on mainland development properties fell to $839 million. The net revaluation deficit on investment properties narrowed 39.2% to $3.641 billion. Hong Kong development property revenue surged 254% to $1.14 billion, with operating profit up 66% to $287 million. Mainland development property revenue dropped 58% to $1.363 billion, and operating profit fell 73% to $208 million. Mainland investment property revenue declined 3% to $4.419 billion, while operating profit slipped 4% to $2.876 billion. Hotel revenue increased 6% to $656 million and reached break-even. The company noted that weak recovery in the mainland property market, persistently soft labour markets, and capacity imbalances continue to pose downside risks to economic growth and consumer spending, requiring additional stimulus measures to support the relevant sectors. Hong Kong's property market has regained momentum thanks to government measures and a warmer capital market, although interest rate volatility and high inventory levels may continue to present challenges. Swire Pacific released its full-year results to the end of December last year, showing solid underlying business performance but pressure on reported profit. Reported profit came in at 2.938 billion Hong Kong dollars, down 32% year-on-year. Earnings per share were $2.17 for A shares and $0.43 for B shares. The board declared a second interim dividend of $2.50 for A shares and 50 cents for B shares, together with the first interim dividend of $1.30 for A shares and 26 cents for B shares. The full-year dividend totals $3.8 for A shares and 76 cents for B shares, higher than last year's $3.35 and 67 cents respectively. Excluding investment property fair value losses, underlying profit rose 9% to $11.373 billion, driven mainly by strong aviation performance and substantial gains from the disposal of non-core assets in the US and Hong Kong. Recurring underlying profit increased 5% to $9.754 billion. Group revenue reached $90.467 billion, up 10.4% year-on-year. Operating profit rose 5% to $4.454 billion, while operating profit excluding investment property fair value changes stood at $10.527 billion, up 3%. Swire Properties announced its full-year results to the end of December last year, featuring strong underlying profit growth but pressure on the books from asset impairments. Revenue for the period was 16.041 billion Hong Kong dollars, up 11.2% year-on-year. Attributable reported loss widened to $1.533 billion from $766 million the previous year. After excluding non-controlling interest, investment property fair value losses totaled 7.716 billion last year, compared with 6.299 billion in 2024, mainly from the Hong Kong office portfolio. Loss per share was 27 cents. A second interim dividend of 80 cents was declared, up from 76 cents a year earlier. Excluding investment property fair value changes, attributable underlying profits surged 27% to $8.62 billion, primarily from the sale of the Brickell City Centre Mall in Miami, along with its parking facilities and adjacent land, as well as the disposal of a Hong Kong industrial project and the 43rd floor of One Island East. Part of these gains was offset by lower rental income from Brickell City Centre after the sale, reduced office rentals in Hong Kong, higher sales and market expenses on several residential projects. MTR Corporation released its 2025 full-year results thanks to substantial profit recognition from property development. Overall net profit remained solid, although recurring railway operations continue to face rising operating costs. Revenue fell 7.6% to $55.465 billion. Net profit declined 6.9% to $14.677 billion, with earnings per share of $2.36. The final dividend was maintained at 89 cents. The total ordinary dividend for the year was $1.31 per share, the same as in 2024. Property development profit contributed $11.084 billion, up 8% year-on-year, reflecting progress on several projects including Phase 3 and Phase 5 of the South Island Line stations, Lohas Park Phase 12 and Huaneng Station Phases 1 and 2. The Tuen Mun Area 16 Station Phase 1 project was approved last November. Depending on market conditions, the group expects to tender Phase 2 of Kam Sheung Road Station and Phase 2 of Tuen Mun Area 16 Station within the next 12 months or so. Li Auto announced its full-year results to the end of December last year, showing geo pressure on both revenue and profit, mainly due to lower deliveries and intensified market competition. Net profit attributable to ordinary shareholders was 1.124 billion yuan, down 86% year-on-year, with basic earnings per share of 0.56 yuan. Revenue fell 22.3% to 112.313 billion yuan, of which vehicle sales revenue dropped 23% to 106.7 billion yuan. Full-year deliveries total 406,300 units, down 18.8% year-on-year. Vehicle gross margin narrowed 1.9 percentage points to 17.9%, while overall gross margin fell 1.8 percentage points to 18.7%. In the fourth quarter alone, revenue rose 5.2% quarter-on-quarter, but dropped 35% year-on-year to 28.775 billion yuan, with net profit attributable to ordinary shareholders at just 6.519 million yuan, down 99.8% year-on-year. The company guided for first quarter vehicle deliveries of 85,000 to 90,000 units, down 8.5% to 3.1% year-on-year, and total revenue of 20.4 billion to 21.6 billion yuan, down 21.3% to 16.7% year-on-year. Technical analysis shows that the Hang Seng Index once again fell below the 10-day moving average at 25,777 points and has partially filled the upward gap from Tuesday, which spans 169 points between 25,442 and 25,611 points. There's a strong chance the gap will be fully filled today, with the next support level at 25,250 points. Iran has stated it will continue to close the Strait of Hormuz. Meanwhile, U.S. Energy Secretary Chris Wright said on Thursday that the U.S. Navy is not yet ready to escort tankers through the Strait of Hormuz, although such arrangements are expected to be implemented soon. Brent crude touched the $100 mark, and the U.S. stock suffered another sell-off on Thursday, with all three major indexes closing at their lowest levels of the year. The fear gauge VIX index rose 3.06 points, or 12.6%, to 27.39. The Dow Jones plunged 739 points, or 1.6%, to close at 46,677. The Nasdaq fell 404 points, or 1.8%, to 22,311, while the S&P 500 dropped 103 points, or 1.5%, to 6,672. The Nasdaq China Golden Dragon Index, which tracks Chinese stocks, declined 72 points, or 1%, to close at 7,094. With oil prices surging, airline stocks came under pressure. American Airlines, United Airlines, and Delta Airlines all fell, with the first two dropping more than 4% and Delta down 2%. Oil stocks moved higher against the broader market, with Chevron up 2.7% and ExxonMobil up 1.3%. Banking stocks weakened, with Morgan Stanley down 4.1% after reports that the firm restricted redemptions from a private credit fund. Bank of America fell nearly 3% and JP Morgan Chase dropped more than 1%. Large-cap technology stocks declined with Tesla down 3.1%, Meta down 2.6%, Apple down about 2%, and Nvidia, Alphabet, and Amazon each falling more than 1%. Microsoft slipped less than 1%. After the market closed, Adobe reported first quarter adjusted earnings per share of $6.06, beating expectations of $5.87, with revenue rising 12% year-on-year to $6.4 billion, above the forecasted $6.28 billion. Subscription revenue grew 12% to $4.39 billion, exceeding estimates of $4.31 billion. Adobe guided for second quarter adjusted earnings per share of $5.8 to $5.85, above analyst expectation of $5.68, and revenue of $6.43 billion to $6.48 billion, slightly above the market consensus of $6.42 billion. The company also announced that CEO Shantanu Narayan, who has served for 18 years, will step down once a successor is elected. The stock fell more than 6% in after-hours trading. In the U.S., last week's unemployment claims fell, indicating that employers are still limiting layoffs. In the week ended March 7th, initial jobless claims stood at 213,000, below the previous week's revised figure of 214,000 and lower than economists' forecast of 215,000. Our stock pick today is Huaneng Power International, stock code 902. Huaneng Power International continues to advance its green and low-carbon transformation. Wind power and photovoltaic installed capacity continue to grow, driving year-on-year increases in new energy electricity generation. In the first half of 2025, newly added grid-connected controllable power generation capacity reached 7,987.31 megawatt, of which new energy installed capacity exceeded 6,262 megawatt. As of June 30, 2025, the group had controllable power generation capacity of 152,992 megawatt with low-carbon clean energy, including natural gas, solar, wind, hydro, and biomass power, accounting for 39.12%. The group's power plants in mainland China are widely distributed across 26 provinces, autonomous regions, and municipalities, and it fully owns an operating power company in Singapore and has invested in one in Pakistan. In the first half of 2025, the group achieved operating revenue of 112.032 billion yuan, down 5.7% from 118.806 billion yuan in the same period of 2024. This was mainly due to overall loose supply and demand conditions and rapid growth in national new energy capacity, leading to a lower generation from coal-fired units and a year-on-year decline in electricity output. Net profit attributable to shareholders was 9.578 billion yuan, up 23.19% year-on-year, and even exceeding the full year 2024 net profit of 7.26 billion yuan. This was primarily because the group capitalized on falling fuel prices by strategically coordinating long-term coal contracts and spot purchases to further reduce fuel costs, driving profit growth in the thermal power segment. At the same time, the orderly expansion of new energy capacity has resulted in stable growth in photovoltaic profits. The explosive growth in demand from data centers will be the core driver, strengthening the fundamentals of power stocks. This impact is mainly seen in three dimensions: growth in electricity sales, revaluation of the ballast stone value of thermal power, and accelerated consumption of green electricity. Data centers require 24/7 stable power supply, making thermal power with peak regulation and supply guarantee capabilities indispensable. Meanwhile, as green computing policies advance, data centers will become major customers for new energy absorption. In addition, in power market transactions, data centers have a high willingness to pay premiums for highly reliable power, which helps power companies improve unit utilization hours and maintain stable electricity prices. Huaneng Power International actively responds to the national policy of strengthening capital market development and enhancing investor returns. Its articles of association stipulate a minimum dividend payout ratio of 50%. The current forecasted this dividend yield reaches 7.4%, providing strong defensiveness. Meanwhile, its A-share price trades at a significant discount to A-shares. Recommended buy at $6.10, target price $6.70, stop loss at $5.80. I do not hold the above stock.